Alrighty.
Okay, you got your slide up, Scott?
I can do that.
Right, we are live.
Let's see.
All right, let's go out of broadcast mode. All right, let's see who rolls in. Attendees.
Attendees, 1, 3, 4. Sweet. They're rolling in now. Good morning, everyone, if you've just joined us.
Yep, good morning. Apologies for the technical hiccup that we had this morning.
Yeah, if you clicked the link early this morning, you would have seen it was erroring out, but Dave's awesome technical prowess got that sorted. Well done, Dave.
It's all right. It just involved your credit card, mate.
Oh dear, never mind. All right, well, hey, while people are rolling in, we might as well get started. So welcome to Morning Startup. My name is Scott Glue. I'm here with Dave Newman, and Robbie Nolan is also an organizer of Morning Startup, and we see him from time to time. But as you probably know, we've got a good session today. We've got James Edwards and Gerrard from Betterlabs Ventures that are going to take us through this fantastic $23 million fund that we've got here in WA that can help out your startups. And if you want to know how you can secure funding and convince them that your startup is the right one to invest in, then you want to listen to today's session because I've got some good tips for you. But before we get into it, what I would like to invite you all to do is go into Zoom and get on the chat section. And if you have any shameless plugs, sorry, can you guys see me? I just see that my start video was off. There we go.
Yeah, we have it.
Hey, everyone. Okay. Yeah, so go into the chat section and you'll be able to use that to introduce yourself, and any shameless plugs, a business success or whatever, please share it with the group. We usually like to get you to stand up in riff and introduce yourself, but this is the next best thing over Zoom. Oh, okay. Let me chuck my hat on. Thank you to the guys from Ammo Marketing for not only helping me hide my isolation hair, but for also supporting Morning Startup during this time of taking it all online. These guys have been great. If you can, go to ammo.marketing and find your way to the Weird Growth podcast and hit the subscribe button. They have some awesome content. They've got interviews with Perth-based founders and innovation folk to keep you inspired. Really, really good podcasts and great interviews. But also check out ammo.marketing and check out their marketing services. It doesn't matter what stage you're in, whether you're just validating your idea or whether you've actually got product market fit and you're ready to hit the accelerator. Go to these guys and they can help you out through every step of that journey. So thank you to Ammo Marketing for helping us out. Dave, do you want to?
I can. We love merch. That's all I can say is we love merch here, right? So Beecham Group, if you haven't got yourself your beer stubby, then if you're a Beecham Group, proud that they've been part of Morning Startup for many, many years now. If you don't know who they are, then check out Glenn and the crew there. They are a boutique recruitment company here in WA. If you're looking for that next job, then check out Glenn and his team. Or if you're simply looking for someone to bring someone on to understand what the market's doing, then check out Glenn. So beechamgroup.com, and they'll be able to help you.
Absolutely. Thank you, guys. Besides Ammo and Beecham, there are a ton of very supportive organizations here in Perth that can help out your startup. So startup news, techboard.com.au, and business news. If you have a story that you want to share, if you want to get the news out about what your startup is up to, Startup News, awesome place. Send it to them and they'll be happy to help get that word out. But also go to Startup News and just subscribe to their daily or weekly newsletter. They've got some really good content and it's a great way to keep in touch with what's happening in Perth and startup land.
It is. It is. If you're looking for some great content, then check out nicheinterview.com.au and Jürgen and the team there. We do record these sessions when we are at RIF, so check out Niche Interview, some great speakers up there that you can go and watch back and learn from the best of them. And last but not least, but the penultimate one, Voltage Espresso. Again, I'm sat here south of the river with my homemade coffee. Is not as good as Voltage. So when this is all over, make sure you go and see Voltage. And as I mentioned, don't ask for the morning startup discount. Pay more, buy two, and we'll just support the local economy and get these guys and girls back up on their feet quickly. And last but not least, Scott.
Space Cubed. Thank you very much, Space Cubed, for letting us take over RIF once a fortnight. We haven't been there for a while now, but we're looking forward to getting back there soon, hopefully. But look, the Space Cubes have a ton of events happening online right now. They also have a ton of programs that can help your startup. Please just go to spacecube.com and check out all the stuff that they've got going on. And there might even be, if there's anyone from Space Cube online, please use the Zoom chat to do the usual. Add your links in there of anything that can help out Perth startups.
So we've got 40 people now online. Oh, we had 39. Someone's obviously dropped off, but yeah, we've got 39 people up online. So if you've got any questions as well as we go through this, I see a few of you have been putting in your shameless plugs, and we will get to read some of those out. And if you have any questions as well for the panelists as we go through, enter them into this, and we will get to them. I will actually create a poll as well at the end of this, and we will ask a few questions that you can answer. Right, any announcements?
So yeah, I'm just scanning through the chat as well. So thank you, Benjamin and Brendan, for doing the shout out for your app, and Michael, it's great. Cool, but it doesn't look like there's any events or anything coming up. No announcements. Dave?
Not that I know of. Do you know of any, Derek? James?
No, the ones I was thinking about happened yesterday and last week, so that's not going to be helpful.
Yeah,
nothing for me.
Yeah,
all right.
No worries. If you know of any announcements, let us know. We'll put them on the mail out, and we will send them across to around the community. Brilliant.
Absolutely. So if you want to get in touch with us for anything at all, maybe you're interested in presenting at a morning startup one day, or you have a topic you'd like us to put on, or you just need to meet someone in your industry, we can help connect and do all that sort of stuff. So please get in touch. We're Morning Startup on all of the things, or contact at Morning Startup if you want to shoot us an email.
Brilliant.
And also check out perthstartups.com.au. It's a Slack channel that Perth-based entrepreneurs just chat about stuff throughout their day. So get on that and come say hello.
Yes, the coffee is finally kicking in for me, that is for sure, especially after this morning's technical issues. I probably should have had it earlier. If you also are wanting to hear about a certain subject, then hit us up and we'll do our best to find you the best presenter for that subject while we're still in kind of semi-lockdown now, while we're still choosing to do this via webinar. Let us know and we will find a presenter for that particular topic.
That's right. Just on that, so in 2 weeks' time, we have Jürgen from Niche Interview and perthvideo.com, and he's going to be taking us through no code. So I don't know if you know, but there's a whole movement around creating apps these days where you don't actually need to be a developer. You can use off-the-shelf software like Airtable and Webflow and a whole bunch of other things to just piece together an application and get your MVP off the ground. And in some cases, even your entire company. And I think there's companies out there just running on no code now quite successfully. So yeah, he's been creating an app in this no code ecosystem, and he's going to share all of his learnings with us in 2 weeks' time. But today, as I mentioned, we have James Edwards and Derek Gerrard, who are going to talk about this great $23 million fund that we've got happening in Perth. So without further ado, let's click the buttons and we'll hand over to, so who would like the screen? Is it James or Derek?
I'll have the screen, thanks, Scott. Cheers.
He likes the control.
I love the control.
Good stuff. Okay, well, if you can hit the share screen, I will I'll shut up and let you guys do the talking.
Okay, still saying, Scott, that you're sharing your screen, I think. We can still see your screen, your desktop.
Okay, stop.
There we go. Perfect.
That's a
There we
rookie
go.
mistake. Jeez.
I know. It's too early in the morning for this stuff.
Can we all see that?
Yep.
Fantastic. We'll get going. Thanks, Scott and Dave, and great to see a good turnout on Wednesday Hump Day in these strange times. Derek and I, let me just go through the first slide. There we go. So just to introduce myself, my name is James Edwards, and I'm the CEO of BetterLabs. And joining me today is Derek, Gerrard, who is not only the fund manager for BetterLabs Ventures, but also we're very lucky to have him as our entrepreneur in residence for RAC, which is fantastic. And the third person there, Kate Warren, might be online, and she's our commercial manager in the BetterLabs team. So she helps Derek manage the fund as well. I feel weird, Scott, that I'm not doing the, if the fire alarm goes off, or, toilets can be found down the corridor. So plan for today, and I do apologize. I'm sure there's a few people online who've heard this before, but hopefully every time you do hear it, you get a new nugget of wisdom. So I'll briefly run through how BetterLabs Ventures fits into the broader RAC innovation program. And then what I'll do is hand over to Derek, and he'll he'll tell you what we're looking for in terms of investments. And then most importantly, how to apply and the tips and tricks on putting in a good application all the way through to pitching and hopefully closing the deal. If we can hold questions to the end, I think, Scott, you mentioned if you can just throw them into the chat area, and hopefully we can work our way through those with Q&A and get everybody out of here around 8:30. So first of all, why innovation for RAC? So hopefully most of you know about RAC. We've been around as an organization since 1905, so we're very old. And our primary business is roadside assist. You'll see the iconic roadside patrol vehicles running around Perth, our motor vehicle insurance. We also have a parks and resorts business, and a range of other businesses that we service our members. We're a mutual organisation, so we are owned by our members. And to date, we've been very successful. So we have over 1 million members in Western Australia, in fact, one in every 2 households. We have a great balance sheet, close to $1 billion, and we are growing financially. We had a fantastic year last year, our best year to date. So I suppose the question is, why the need to innovate? And the answer to that really is the little autonomous car on the screen. So most of our revenue base does come from motor vehicle insurance, around 70%, and another 10 or 15% from our roadside assist program. So you can imagine if in the world in 10 or 15 or 20 years time, where we have these autonomous cars and electric cars running around Perth, we're going to have fewer accidents, which means less need for insurance. We're going to have electric cars, which are much more reliable than internal combustion engine cars, so less breakdowns. And of course, a third wave coming through is ride sharing, which is showing up already with the reduced vehicle ownership. So people aren't going to need personal car insurance. So while we are still seeing growth in our current business, we know this wave of disruption is coming. And so my predecessor and the former CEO recognized this probably about 5 or 6 years ago at RAC, and developed a fairly robust innovation program with the main aim of making RAC more resilient to this upcoming disruption. So we knew we had to innovate to be robust and to be resilient, but the question was, where do we innovate? As I mentioned before, we do have our fingers in a lot of businesses, but we really needed to focus on, for that transformational innovation, which can be quite expensive and lengthy, where do we want to focus our resources and energy? So we did a bunch of scenario planning, and that's really looking out beyond 2030 at what the world might look like. And dropping out of that, we identified what you see on the page here as our emerging innovation domains. So think of these as swim lanes with respect to where RAC are going to focus their energies to identify and hopefully incubate and leverage new business opportunities. Now, 3 of those, the member community, next gen insurance, and mobility of the future, are quite adjacent to the current business models. But the new ones clean tech, life, work and money, and third age, which Derek will talk about a bit later on in the presentation and how they apply to our fund, are completely new to RAC. So clean tech is really around opportunities in energy, waste and water. The third age is opportunities around the aging population. So think about maybe it's care, it might be around downsizing their houses, it might be around wills, etc. And the third one there, life, work and money, is how we envisage people might be working in 2030 and beyond. So think gig economy, co-living, digital currencies, etc. So these really helped, I suppose, inform where we wanted to put our resources in the transformational energy space. So we now know we had to innovate. We now know where we wanted to innovate. The next question, I suppose, was how are we going to innovate? So this is the Boston Consulting Group's corporate innovation toolkit. Some of you might be aware of this. It is, I think, fairly reflective of the broad innovation programs that most corporates have, certainly in Australia and overseas, and it's quite reflective of what we do at RAC. So if you think M&A, buying in new capability, new companies, new IP, internal R&D for that longer term maturation R&D, so mostly applicable to biotechs and say motor car companies. Then you have two other avenues, corporate ventures. So that's really about taking equity stakes in startups and leveraging those growth opportunities. And the final one there is internal prototyping. And that's really about identifying business opportunities for us in those 6 emerging innovation domains and putting them through our innovation process and hopefully incubating and commercializing new business opportunities. So for RAC, what we realized is certainly for the corporate venture side and the internal prototyping side, to give those ventures the best opportunity, instead of having them residing in the main business, it was best to reside them in a separate entity with streamlined governance processes, so the bureaucracy doesn't strangle them to death, and very fluid, I suppose, processes that we can meld and adapt to make ourselves as startup focused as possible. And to that end, BetterLabs was born around 3 or 4 years ago. It's a separate entity, it's funded separately, it's housed separately in the Flux co-working space at Space Cube. And its main focus is the internal prototyping of new businesses. And then what we're here to talk about today is the RAC Corporate Venture Fund, which is BetterLabs Ventures. And so that was launched officially in September 2018. And as you can see from the slide deck, it has gone very well so far. We've had over 230 applications, 55 pitches, 26 initial DDs, and we've executed 4 deals with about $2.5 million of funding so far. And fingers crossed, we're hoping to close our 5th deal in the next week or 2, which is exciting news. The deal so far is Space Deco, which is a +8 alumni, which is fantastic. Power Ledger, Complete Home Filtrations, which was our first deal post September 2018. And also we've taken up sponsorship and of the +8 2020 program, which is up and running at the moment, which is exciting news. And hopefully most of you would have seen the initial fund was a seed fund of $3 million. But in January this year, we've got approval from the RAC board to expand that by another $20 million. So now we're focusing not only on seed funding, but also on Series A and B funding, and not just in WA, but certainly both in Australia and nationally. But with the key metric of we need the startup that we're investing in to have an impact back into WA. Fantastic. So that's enough from me. I will now hand over to Derek, who will tell you how to apply to the fund and tips and tricks on how to put in a good application. Thanks, Derek.
Awesome. Thanks, James. And thanks to the Morning Startup guys. Having been involved in startups most of my life, these guys have been doing hard yards for many years, supporting our ecosystem here. And I don't like getting up early. In fact, I realized I almost missed the time today. James is calling me at 7:29. Where are you? But for you guys to put this on every week, I think it's fantastic, and to see the attendance grow over the years. Just briefly, my background, because might help slightly as we go through this. So I have been in tech for over 20 years and actually started that with PwC, but back in the .com era, which became the .com crash, of course. Weren't called startups then, we were called .com companies. And then through that, managed to sort of get exposure to the US and UK markets. Having returned to Perth about 15 years ago, I ended up co-founding my own startup company. And I guess I mentioned that because I've been on that entrepreneur side which I suspect a lot of people on the call are, and really kind of navigating how do we raise capital, what's the right time, how do we attract investors, and when we were doing that back in sort of 08, 09, it probably wasn't as clear as it is now. And anyway, so that company, GreenSense, fortuitously was sold to a public company, and we had a great exit. And so since then, in the last 4 or 5 years, I've been trying to, I guess, give back to the startup ecosystem and knowing what that journey is like. And part of that has been around capital, of course. So set up a corporate, a private equity group called Go Capital. And we funded companies like Isotana and Health Engine, which people might be familiar with. I've got, as James was mentioning, involved in the +8 program and helping the accelerator there and bringing funding to the table, and obviously the 6-month program. And then this role as well, which has been helping the RAC the last couple of years think about their innovation strategy. And I guess looking at that journey over 4 or 5 years, I'm pretty stoked to be involved with what we're doing here. I think there's something that Perth needed for a long time. I think the RAC is really kind of raised the bar in terms of the role that corporates can have to play in supporting startups. And this fund as a corporate venture fund, I think if we could see another 2 or 3 of those around Perth, we'd suddenly have a funding pool that makes sense for the size of our startup ecosystem. So glad to be involved in certainly what BetterLabs is doing and leading the way. I think today we're just going to try and touch on a few areas which are partly just hopefully value add for you and your journey in your startup, but also the kind of things that we're looking for when you apply. And I'll go through the application process shortly. One thing I'd probably say up front is that, because people often ask this question, so the fund itself, we're looking to deploy that $23 million over the next 2, possibly up to 3 years. We think that's about the right runway of capital deployment based on what we've seen so far. You'll see from the numbers that James put up, we're getting roughly about 100 applications, maybe 150 in a year, which I think is really exciting in terms of what's actually going on in Perth right now. And we'd be looking to make 4 to 5 investments in any given year. So ideally build up a portfolio over time of somewhere in the vicinity of 10 to 20 companies. And that's kind of about the right odds in terms of building your first portfolio in a fund. So when you apply, I guess what I'm trying to say here is it's not like we're only open for applications in the next couple of weeks and you just have to hurry and get something in. You know, there is a few years that money will be deployed over. Hopefully, if we get it right, there'll be a fund that follows that. But what I would say is that when you do apply, you want to put your best foot forward. And what people often think is, I'll just give you enough of what's going on at the moment and write down my idea, or you know, I know there's a whole bunch of gaps, but maybe you guys will fund me and help with that. What you need to understand is that we're seeing so many applications. Usually the way the process works is that when we're going through our due diligence, you know, we probably at that point have already, you know, loved your idea, we've loved where you've got to, we think you're great as founders, but at that point, we're trying to look for reasons that we shouldn't invest, not reasons we should. And so if there's too many gaps or too many flags that are there, often we'll pause the process. And so if you want to get funding, I guess it's making sure you're doing your best. And some people just forget that. They almost treat it like a charity or a handout or something as opposed to an investment. And so I just want to make the point that you're putting your best foot forward. Now, that's not to say that if you miss something and you weren't aware, we then walk away. Most of the investments we've done, and in fact, for example, the one we're hopefully going to close in the next week or so, we've been working with them since October last year. And there were some things that went right and we talked about that and they went and fixed those and they came back. And that's actually, you know, really good for us to see that the founders are coachable and listening and trying to make changes that are required. And often it's not actually about the the product itself necessarily. It often relates to business hygiene, what I would call business hygiene. So the cap table's not right, or there's some contracts that aren't signed, or these types of things. So just trying to make that point right up front. Make sure business hygiene's good, everything's in order. I'm going to take a really close look at the business, so give yourself your best shot, but don't feel like you've got to rush in the next 24 hours to get an application in. So these things we're looking at on the screen, they kind of, I guess at a high level, just a pass of things that we would do. And I'll just kind of touch on each of those that will help making sure you think about these when you put your application in. So the first thing is what we've written there is the problem solution fit. And I guess here is what we're trying to say. There's lots of people that come up with good ideas. There's lots of people that come up with solutions. But I've learned over the thousands of companies I've seen and worked with now that if there's not a clear correlation between a problem that a customer has and a solution that they will be prepared to pay for to solve that problem, there is no business. And too often those things are missed. So you'll find a solution, you're kind of building something and you haven't necessarily aligned it back to the real problem that the customer has. Or the other issue that happens is there is a problem and you have got a solution, but you haven't validated enough that the customer is actually going to pay for that. And so, I hear all sorts of things like, well, I started with a freemium model, or I'm just kind of giving this away to get some feedback from customers. And they're all important things, of course, in your journey. But at the end of the day, if someone's not going to pay you $1 for the one thing you're building, there is no business. And ultimately, we need to understand that there is a business model and a market for that. One of the things that often happens is that when people come in and pitch, you're not thinking about this problem, customer, solution story. You launch into features of your product. And that's not what we're interested in. We're really interested in this validation of the problem solution fit. So be careful you don't go to product features instead of this kind of thing we're talking about. The second thing I should say is innovation. And we are, at the end of the day, we're an innovation fund. We're thinking about the future. We want to invest in high growth businesses that are disrupting and changing the way we do things. When we say innovation, though, most people often think that that's just technology. And tech obviously has a massive part to play in that, but innovation can look like all sorts of other things. So innovation could be about a different type of customer service. It could be a different pricing model. It could be a different type of operational efficiency. And what we've seen is that companies that are innovating but too far in the future actually become hard to think about the investment thesis around how long is it going to take to actually develop that, improve that, get traction, build a market, and ultimately get return. So just be careful you're not too far out, but a couple of steps away from where we are right now, seems to be the right place to be in terms of building business and the type of things we're interested in investing in. When you think about innovation, the other thing I'd say is this is where we like to think about the word I would use is defensibility. So as you build market share, how are you going to defend against either those that are already incumbents and in that market and going to try and stop you growing, or those that are going to come after you and defend against that? And it's not always the most obvious thing. That little story I like to tell is that Apple, when they launched the iPod, at that point in time, Sony was the largest personal music device player in the world. They never should have lost that market. And Apple did a number of things. The iTunes store was one of them, but one I felt was quite interesting that's out of the box thinking is that when they figured out how to get MP3s on a very small hardware device, that piece of hardware, they went and bought the world's supply. So by the time Sony caught wind of what the iPod was going to be, they actually couldn't catch up because they couldn't get the parts they needed to build the player. And so that gave Apple a 12-month head start, and obviously they won that market, and it's been never been able to recover since. And so your defensibility strategy can be a bit more out of the box thinking. Often startups would say to us one of three things: either it's about my brand, I've got a patent, or I'm first to market. And my view is typically they're not the right answers for your defensibility strategy. The reason is brand is important, but brand really has value if you're a Nike or a Coke or something like that. The reality is a startup with a small market, brand is not where your value lies. The second thing is the patent. Now, for certain industries, patents are obviously really important, but the issue for a startup being your only defensibility story and your patent is that if someone actually copies your idea, you probably don't have the cash to chase after them, and it's probably going to be difficult to raise the money just for that purpose. So, you know, the value in the patent only comes later down the track. And the first to market piece, again, there are some situations where that is your defensibility strategy, but the reality is first to market is usually the company that educates the market, and it's the second and third that actually win the market. And we prefer you not spending time educating the market, but winning the market. And I think, you know, one of the classic stories there is Facebook and MySpace. So MySpace, no one had really heard of social media, and they couldn't figure out how to monetize that business, and they educated the market on what social media was all about, and then Facebook was able to come along and win that market. Okay, so then we think about the market itself, and this is kind of interesting one. So often when you're talking to venture firms, we do have a certain return profile, which I'll talk about when we get to the value piece. But we're not necessarily thinking about you taking over the world. Now, if you've got a business that can do that, that's amazing, and we would absolutely love to back you. But we are pretty much, there is one other fund, I guess, but we're pretty much WA's only fund at the moment. And so one of the things that we care a lot about is backing Perth founders if we can, and seeing a WA impact. And so the market needs to be reflective of something that you can definitely address and that you can get to. But sometimes when people talk about global markets, we get a bit concerned that you've got these massive aspirations and don't really understand what it means to move into other geographies and all the things that go along with that, and the setup costs, and understanding it's a different type of customer and a different price point and these kind of things. So really, like, if your business can demonstrate you could get to, say, even at a minimum $10 million revenue, that's a business that on a value basis can generate a fair bit of return. Now, obviously, we'd like to see that 50, 100, 500 and beyond, of course, but the entry point for market size is possibly less than you think. But I would also, because I'm not sure who's in the line, also make the comment that it's also maybe larger than you think. So sometimes we get some people that have got great ideas who are building what I would call more a family business that might do a couple of $1 million revenue, and it's awesome and it's great, but that's not the kind of business we're thinking about. So it's not definitely on that small side, but it's probably smaller than you might realize. And what we're more interested in is that you understand that market, that there's an Australian impact in some level, whether that be you're Australian based or you're tackling a national market, before you can then go to the global opportunity. And you'll understand that when we talk about the return profile and value in the moment. The company we're backing, that we're just about to close, they're an Australian company originally. They've attracted some US VC funding. So part of that, they're flipping up to the US and they're going to become a Delaware Corp, but they will remain head office in Australia. And so we like that story. They've already got clients here. They've got clients in the US. We're backing an Australian story, but in this case, it makes sense to be US registered, and that's what they're doing. So, a little bit about market sizing there. So next thing is the founder team. And we talk about this because if someone said to me, you could only, of all the things that you have in your checklist of stuff you're looking for, you could just pick one thing, what's the one thing you would back? And for early stage ventures, this is it. It's all about the founding team. And so it's really important. And a few things I'll talk about that. So in an ideal situation, your founding team has a mix of technical knowledge for whatever product you're building. So if it's software, you've got a great CTO or equivalent in your founding team. You've got industry knowledge. So you've come out of the industry and understand all of the intricacies that go along with that. And you've got commercial knowledge. It's pretty rare that you get all three in one person. And so we're expecting that there's a founding team of at least two and possibly three if you need a combination of those skills. And when we talk about founding team, from the moment we're interacting with you in the nicest possible way, if you're going to be looking for funding, you need to remember that due diligence is on. So if you ask a question today, I'm going to look at your name and I'm going to see what question it is. And I'm going to be thinking about, is that a smart question? Is that someone that knows what they're talking about and what they're looking for? And then when you apply, I'm going to remember that kind of stuff. And because every interaction counts when it comes to, that's probably going to close up all the questions for the day, but I don't mean it like that. Because the point I'm going to make in a moment is to be yourself, by the way. but it's really, really important. And so a couple of things, let me give you some tips on that to help with how you do that well. The first one is, like I said, absolutely be yourself, right? We don't pretend to be someone you're not. Don't pretend to be who you think we want you to be, just be yourself. And as part of that, I would say whenever you're pitching, always come back to remembering why you got into this in the first place. You're a smart person. You found this problem or this thing that you want to solve. You've given up everything else you were doing to put your heart and soul and life into this thing. And often when you're running a startup, there are so many knockbacks. There's things that don't go to plan. There's customers that keep saying no. There's investors that knock you back, and it's really hard to get down on yourself. But you don't know whether the next conversation is going to be the conversation that is the breakthrough moment you need. And so you need to treat every conversation like it's the best and the first that you're having. And so the way I think is a good way to do that is to, before you go into your pitch, take a breath, just calm yourself and remember the why. It's like, this is why I'm doing this. Just because we don't back you or someone else, it doesn't matter. You've got your own conviction, and that's good. And sometimes just reminding yourself about that gives you the energy that you need to, put your best foot forward. The other thing I just touch on with the founding team is just a little kind of tool we use, which we call the 3 C's. And this is character, competency, and chemistry. And let me just briefly explain what they mean. So character is, we want to know we're backing founders that we can trust, that they're honest and they're transparent. And this is really important because at some point in your journey, once we've invested, stuff's going to go wrong. It's inevitable. That's the journey of a startup. And we just need to know that you're not going to hide that. And that's not because we're trying to catch you out. It's because we actually want to help. If there's something that's gone wrong, we might be able to help solve that problem with you. And so we need to know about it in enough time and early on and things like that. So that character piece is pretty important. We also want to make sure that we're backing someone that's going to, for the future, be making ethical and moral decisions in an appropriate way within the business and the way you treat your staff and all those type of things. So character is pretty important. The second thing is competency, and competency is about being able to demonstrate some proof that you're good at what you do. Now that doesn't have to be you've run a startup before, but it might be that you had you were top of your class in uni or succeeded well there, or it might be that you've had a previous business venture, or you did really well in your career and you've got you had some great progression or something, or won an award or something, but just some level of proving that you've got the ability to do this. Competency and character, I think we can always continue to develop in life, and they're important skills to work on. The final thing is chemistry, and that's literally, do we enjoy spending time together? Are we going to enjoy each other's company? Because the reality is we're going to spend a fair bit of time together for, what could be a who knows, 5 to 10 year journey, and we're going to have to be around each other a lot. And so it's almost like the beer test or the coffee test. Are we going to be able to sit down once a month and have a beer and enjoy each other's company? And it's just some people, we just, you don't click with us, we don't click with you, and that's life. I just think life's a bit too short to put yourself into that place because it carries an emotional weight that you've then got to carry. So, but what I would say about all of those things is that whilst we're thinking about that with you, you should be thinking about all of those things with your investor as well. What's their character? What's their competency? Have they done deals? Have they really got money? Can they do what they say they're going to do? Do you have chemistry with them? That thing has got to be 2 ways. Okay. I've got a poll up on my screen, so I can't see the next one. Traction. Oh yeah. Okay. Right. So am I looking for funding? No, I'm not actually. Sure. So traction. All right. This is probably the next most important thing that you need to think about. And traction is that your business has not just been set up a week ago. We need to probably have been around for about a year. So you've got over some of those early startup corporate structure type of things, and everything's in place from a business hygiene perspective. And we're really looking here for customer traction. So I'm not a huge believer in the whole idea of the freemium model, or we've given a whole bunch of stuff away for free and we're going to think about how we're going to monetize that. And I know there's different views on this, but I've seen too many freemium type models not ever figure out how to monetize. And at the end of the day, until you've got one customer paying $1 for whatever it is you're building, everything in your business model is an assumption. And the sooner you can demonstrate that you've got revenue, the sooner we can de-risk your business model. The sooner we can do that, the more likely we are to pay a higher valuation closer to probably what you think the business is worth. So that traction is really important. Now, there are other ways to measure traction, of course, downloads, conversions, whatever that looks like. But those numbers, if it's not dollar related, they need to be pretty significant and probably more significant than you're thinking at the moment. I think that's probably enough on traction. I think, the other thing I was going to say is that we will invest pre-revenue. But when we say pre-revenue, that doesn't mean I've got an idea and I'll get revenue at some point, or I haven't figured out my business model, or I haven't tested pricing, or I haven't had feedback from my customer. What we mean when we say pre-revenue is you don't necessarily have to have got income through the door yet, but you definitely need a very clear path to how you're going to get that revenue. And so that might be, we've done a whole bunch of customer testing, we're in beta at the moment, and when we know those customers are prepared to pay this much, we've surveyed them and we're expecting that we're going to convert 30% of our beta users to paying customers or something. And if we believe that story, you might not have revenue, but we're prepared to back you at that earlier stage. How am I going for time? I probably need to speed up a bit. So, and then the last piece, value. So value, what we mean here is we're thinking about what value can we bring just beyond the capital. Obviously, that's part of it. But we like to make sure you've got a board set up, for example. I think having a board where you've got someone who's not in the business that you're checking in regularly with on a once-a-month basis, and having to, even though it's your company and you're making the decisions, but to report back and say, well, we said we were going to do this and we didn't, and getting some input from people external from the day-to-day, that's a really healthy thing to do. So think about what other value we might be able to bring. I'll just touch on the fact that can't be, okay, now you've invested, can I access the 1 million RAC members? It's obviously we're building a portfolio. We can't put everyone straight in front of the members until we know that that company's got some longevity and is going to perform over a longer period. So that's not something we'll do up front, but it is something we can do in time once you've proven that you're succeeding in your business model. And if there's a place that makes sense to make that type of introduction through the RAC magazine or through the member benefits and things, we can look at that. The other thing I want to say about value is really the valuation metrics that we're looking for. So at the lower end of the scale, I mean, we'd probably invest the smallest check of around 100 grand. The smallest we've done so far is 250,000, by the way. And the reason we expanded the fund was to allow us to do follow-on investments in the companies we've invested in, as well as tap into more Series A and Series B investments, which means we can do up to a $3 million check size in one investment, which I think is pretty exciting, again, for the Perth market. When we invest, we are typically looking for somewhere in the vicinity of 10 to 20% equity. The reason for that is if we're too close to the 40, 50% mark, if something goes really wrong, we've got to jump in and take over, and that's kind of not really our mandate. And likewise, if it's less than 10% in an early round, we know there's going to be future dilution, and that's probably, again, not interesting enough for us. So roughly speaking, it doesn't always work out like this, but to give you an idea. So if you were to think about a seed round and you're looking for $300,000, just by virtue of what I've said, the fact that we're looking for 10 to 20%, you can see that your business is likely to be valued around about the $3 million mark. And no matter which way you cut it, for most companies that have got to a stage that are doing a seed round, that's roughly going to be about right. So we've got ways we quantify that, but you need to kind of keep that in your mind, because if you come in and you're like looking for a ridiculous valuation, we're probably not even going to bring you in for a meeting. And if it's too low, we're not excited enough around the growth trajectory. So there's a bit of an art to get that right when you're pulling your business model together. The other thing I'd say about the value piece is that we are a venture fund, which means we're looking for a return. And venture investing is one of the highest risk asset classes there is, which means we're looking for high returns. If we just want to get sort of 10%, 20% type returns, then there's other ways we can do that. So we are looking for, at a minimum, a 10 times return on the capital we put in. Now, you need to think about that when you're presenting your business model. So let's just use that seed example I was talking about before. We put in $300,000. We value the business at $3 million. We now own 10%, or roughly, slightly different on a post-money valuation, but we're expecting your 3 million valuation to get to 30 million for us to be able to exit and get 10 times return on our money. So when you show us a business model, you've got to show us a business model that convinces us you can get the company value to $30 million. Now I'm using the low end, but you think about the company that comes along and goes, well, we're worth 10 million. We might buy into that, but we've got to then understand that you can get that company to $100 million valuation. So just make sure you're thinking about the pros and cons of how your valuation expectations are being set. Okay, let me just quickly jump to the process of how to apply. James, if you go to the next screen. Is there a way, Dave, I can get rid of that poll at all on my screen? That'd be fine. No, it doesn't look like it. That's fine.
I will close it.
You'll close it? Oh, okay.
Close the poll. Sorry, that's my mistake. I thought it would.
That's right. I just don't have notes, so I can't actually see steps. That's right. I can probably remember anyway. I'll keep going just for the sake of time. Okay, so everything for us is via application. I always say this, and I know it comes across really rude, and I don't mean it to, but when we're seeing so many companies that are interested, we unfortunately don't have capacity to just grab a coffee with everyone to chat around whether you're ready to apply or not. So don't, after this meeting, kind of say, hey, can I just grab a coffee or a quick call? It's not that I don't want to meet you, I'd love to, but it's just not practical. So the way you start the process, thanks for that, is via application, which you can go to. I've just put the link in the chat earlier on, but it's betterlabsventures.com.au. If you're not sure, better is to just apply, and then if you apply and you're not ready, we don't then go, we're never going to speak to you again. We will let you know, and we'll try and tell you why. We are probably, I think, from my experience, the friendliest investors, and certainly friendliest venture investors you're ever going to come across. We do our best to be very transparent in our process and give you feedback along the way to help. And it's part of our values and the things we're trying to do to support the Perth startup ecosystem. Anyway, so application, it should take you about 10 to 15 minutes if you are ready, and it's the kind of things I was just talking about. Who's your customer? What's the problem you're solving? Who's the team? Those type of things. About 10 to 15 minutes. Once we've got that, our team will take about a week to get back to you. And if enough of your application meets our investment criteria, we'll invite you to come in for a 1 hour pitch. That's usually about 30 minutes of you presenting and about 30 minutes of us asking questions and things. Really important here is in your pitch, just try to make sure your pitch is consistent with your application. Too many times we've seen an application come in, and one of the things that changes is the amount of money people want to raise. And so they've asked for 500,000 in the application, and by the time they get to us, they're asking for $1 million or something like that. The problem is, if you go back to one of the key criteria we talked about was the founding team, you've now got an issue, because either you've just got greedy because you're like, oh, maybe these guys are interested, I better ask for more money. Or to me, you've just failed the character test. Or you've suddenly changed your business model in the week since you applied, which is probably a competency issue because you're changing your model too often. So just be careful, right? I'm just trying to say, make it consistent. And the reason is that the pitch really is just the face-to-face storytelling version of the application that you've put in. So make sure those two things line up. After the pitch, our team will chat around whether we think you're a good fit for our fund. And if so, again, within 1 week, we will come back to you around, we've got their request for information. Think about that as a preliminary due diligence process. It's at that point only would we sign an NDA. And then we'll ask you for contracts and shareholders agreements and product information and the things you'd expect in a due diligence process. We will go through that, which would normally take us around 2 to 3 weeks. And obviously there'll be a bit of backward and forward and clarification and questions during that time. If that's all looking good, through that process, we'll be talking to you around what a type of investment would look like from a terms perspective, making sure we're agreeing on valuation and the money in and all those types of things. We then, before we can offer you a term sheet, have an investment committee that we go to get approval from. So we draft all that up, it goes to them. Once they've approved that, we get to this term sheet phase where we offer you terms. Now in there, it's pretty standard venture terms, but not aggressive is the way I would think about it. So you're going to understand the money. We're going to ask for it to be fully diluted, meaning any employee share schemes or non-converted equity happens. We're going to have an anti-dilution right, a liquidation right, and a preemptive right. I can talk to you about those in the question times if people want those explained, but they're pretty kind of standard and not too aggressive. Relatively founder friendly, I think. Assuming you sign the term sheet, we'll then go into a final due diligence process. We'll do paid background checks. We'll get our lawyers to get involved to check shareholders agreements, and in theory, you'll be preparing completion documents, and so we'll be reviewing those. That usually takes longer than we'd like, but again, we allow a week or two there, and then obviously we make the investment and get involved in the company. So if everything went well from the time you applied to money in the bank, that could be about 2 months. That's really fast, by the way. I know it won't feel like that. But if any of those business hygiene things aren't right, or there's too many questions in the DD process, that could extend out to 3, 4, 5 months. So just again, setting expectations there. So I think on that note, I'll pause, probably just actually one final comment before we take questions is we are at the moment, of course, having to apply a COVID lens. So it's not that we're not investing, we are about to close, but a deal shortly. But we do need to look at how you're thinking around the impact of COVID. It does mean that for certain industries, we just can't invest right now because it's just not clear enough for you or for us. And we're not about survival capital, we're about growth capital. It probably also means that there's going to be a bit more of a realistic thought around the pricing of your valuation. Because again, markets are going to be very different over the next couple of years, depending on the industry that you're in. So just keep those things in mind as to whether you think now's the right time for you to be raising capital. But for us, we're still open for business and looking forward to making some investments over the coming year or so. So let me stop there and then, take questions.
Thank you very much.
Fantastic.
Yeah, there's been a few questions. Well, there was one question here. So firstly, I've put the poll up. Sorry that I will restart it again just to see if there was any difference in the numbers. But there was a question here. I'm just going to read this out because it's quite a long one from somebody called CS. I'm not sure who CS is, but it's a question, Eric. Interested to understand the process, frequency of investment commitment meeting, nature of non or no go or no-go approval process, and anticipated timelines for decision making. I think you've answered that one in saying it's quite short. And whether or not you need a unanimous vote as to whether or not you would proceed with an investment.
Right. I think that might have come up before I got into the process. So if that's a bit clearer. I mean, our investment committee meeting meets once a month. We meet regardless, but if we need to close a deal in between that month, we can do that through what we call the circular resolution. So we don't have to wait for that meeting, although often that's easier to get a deal done. At the moment, the reality is every deal we've put up to investment committee, we've had a 100% hit rate because we do a lot of work and they're very, very supportive of the process that we have, which I've gone through. And that's a very, so they know by the time we're putting something up, there's been a lot of time with the company and a lot of work done behind the scenes. So, but they do have the final say. The investment committee is part of the executive team of the RAC. The one thing I would say, and I guess why I said right at the start, having been on the entrepreneur side trying to raise capital, one thing I hated was you'd go and pitch and then you hear nothing. And then you sort of feel like you've got to write to the investor and you feel bad about that. You don't want to get that communication wrong. And it's just a horrible dynamic. And I really, really don't like it when investors sit in the room and think they're the better person. It is like, I hate that dynamic. It's horrible. And so I suppose what we've tried, and it's not true, by the way, everyone's a person and it's just different life experiences. But I think one thing we're really trying to do is to change that. We don't want that culture. That's not part of who we are. So we will let you know every meeting when we're going to get back to you. It's usually 2-week turnarounds. I've gone through what that looks like at a generic level, but we try and be really upfront. If we're not going to invest, we get back to you as soon as we can. And if it's appropriate, we'll let you know why, because we think there's a learning experience in that might help you raise capital down the track, or it might be that you're not a fit right now, but if you do these things, hey, come back. So I think you'll find if you do think we're an investor for your business, that process would be a helpful one and a transparent one.
Okay,
right. There's a couple of questions here on the same sort of theme. Hey, Derek, do you support a solopreneur business? We have built a platform, but my company is me, but I've got all work done by a tech partner. So how do you think about single person founders? Yeah,
we have Complete Home Filtration is a single founder business. So yes, we obviously do. As I said before, we're really looking, in that founding team, we're looking for a combination of commercial, industry and technical skills. So, and to be honest, I do think that the experience I've had in all the businesses I've been involved in where it's a single founder, it's just harder because when you come across challenges, which are inevitable, you're kind of on your own trying to figure out how to make those decisions. It means you don't always, you just miss out on the other input and the iron sharpening iron kind of dynamic that occurs, I suppose, where you're getting more brains around the table, and particularly where it's people who are incentivized through alignment because they own the company. And so there is a different dynamic that comes with that. Once we invest, we can partly play that role by getting involved at a board level. So yes, we would, but you need to be able to make sure you've got an answer to the technical, industry and commercial skills. The reality in Perth, it's pretty hard to build up a solid development team from the beginning. So I'm not averse to MVP being built by a technology partner. But what I would say there is if the core innovation in your business is around technology, pretty soon you've got to be able to build up that capacity internally, because again, there's just an alignment issue when it's done with a third party. So no issue with that being the start, but we would be wanting to understand how you're going to build up that capacity. And to do that, if you don't have the technology skills, you need to think about how you bring on a technology leader in the business that's incentivized the right way to align to the business outcome. Again, not to, I say this as someone that I was a developer, like wrote code when I started my career. And for people that think I can just manage a technology company and I'll be fine, you can't. You don't understand the decisions they're making on architecture and development platforms, and you can have the wool put over your eyes without realizing it. So you do need technical lead in your business at some point.
Brilliant. It goes back to the saying, which is you can't fully run a restaurant until you understand what the chef does.
That's right. Yeah.
There's a question here from Brendan. Is it required that companies you invest in need to have a direct impact or ability to distribute through the RAC business outside of a financial return?
Not at all, probably the opposite, to be honest. I mean, the domains that we've created that we would like you to be involved in, they're pretty broad. Clean tech, there's energy, water and waste. There's a lot of stuff there. Life, work and money is a very broad bucket. I won't go through them. They're on the website and James talked about them. But they're deliberately picked to not be related or adjacent to the current RAC business. I think what's nice about knowing the RAC is behind the fund is that we are an investor, unlike probably most in WA, that if you get seed investment from us, we could follow on. And that's pretty attractive to streamline your future funding rounds. And that's something we would want to be doing. We may well be your acquisition at the end, depending on how well the business goes. There's a lot of ways the business might eventually exit. But one of them is that it could be the RAC, but it might be nothing related to mobility or insurance. And that's part of why they're in this. But definitely not an expectation that you have to distribute through the RAC.
This is an interesting question actually from Amit, the curly one. What are your strategies if the startup doesn't perform as expected, e.g. doesn't grow and give you that 10x return?
What do we do?
Yeah.
We come after your children and your kneecaps and anything else that we think is of value. No, look, I mean, at the end of the day, we will end up, when we invest, we pretty much 100% of the time we'll take an observatory board role. We won't put a director on because it doesn't make sense for us just with the backing that we have, but we all get involved or we help you set up that board and we'll have visibility of that. And so part of what I talked about in terms of character and transparency in your business is the reality is when we make an investment, a key part of our valuation decision, actually I'll just touch on this quickly, is two things. One, it's the progress you've made to date, we apply value to, and then we apply value relative to how much we can buy into your business model. So that forward thinking budget that you've created. Now you're going to set that and we're going to agree to it at that point in time. And so together we're looking at whether we think that's realistic and the pricing levels are right and the scaling levels right. And that's what we're investing in. Now the reality is that's probably wrong because as a startup, there's so much learning to happen. So we're all making the decision at that point in time, but by being involved on a monthly basis, we're also going to understand if you're not getting to the growth we're expecting that things have happened along the way, and we're aware of that and we're working on that together. So part of building a portfolio is that, it's 1 in 10 that we expect to go really, really well. In fact, the venture metrics is it's 1 in 10 should get 100 times return and that'll make up for the rest. So we understand that dynamic. And if you think about it right now, our portfolio's young. We've only been going just over a year or so. And I think a lot of people would be familiar with the Space to Go business. I mean, we invested based on a growth trajectory. No one knew COVID was going to come along. And when you're hiring out space and we're no longer allowed to meet, that business model changed like literally a month ago. And we're aware of that. And so we're working with them on that and thinking about how do we get through and how do we, make sure we're here on the other side and what can we do in the meantime and things. So things change and we're aware of that.
Mhm.
Okay. There's a couple of questions here from Andy Dent from Touchgram. So if addressing a global market, including the US as a major part, do you think it's important to get a co-founder over there?
I guess if you're in Australia and you're thinking you've got to go to the US, I mean, like I said before, we'd really understand why that's the right geography for you. And it's not that it's not, but just needing to understand. I mean, obviously bigger market, yes, but bigger market doesn't equal better. And I think a lot of people that haven't experienced the US market, like I've worked there, sometimes we have a bit of stars in our eyes that it's the place you have to get to. And I'd rather be more interested in you knowing a market that you understand as opposed to just an assumption that you've got to get to the US. So I'll just say that first. If you are going to go there, like it's a different place. Like it's bigger market means more competition, harder to get, the funding sort of structures look different, the investors are more aggressive. There's a lot of other things that we'd want to understand that you're well across. Every time you enter a new geographic market, I treat it as almost another business model you've got to create because your target customer is probably someone different. There's different cultural issues. There's possibly different price points, different competitive markets. And so you really need to make sure you understand that. So do you need a co-founder over there? Well, I guess that depends on the answers to those questions I was mentioning before. The company I was referring to that we're just backing, they've got staff in Mexico, staff in Sydney, and it's just their investors and registration that are in the US. But for them, the market they're going into makes sense. It's America based on the industry and the product that they're selling. So that one, we kind of understand. So it's just about, very much case by case, I think, on it.
Okay. And do you see a strong advisory team as making up for being a solo founder by any chance?
Sometimes. What I don't like, this might be a controversial thing to finish on, but what I don't like is that, there might be some of these people at the line. I don't know, hopefully not. The startup industry is a sector that people try to sell to. And one of the things that I don't like is that there are some people that will sell services to startups and go, I can advise you, and knowing you can't pay for that, they take equity. So if you've got an advisor who is successful, that loves you, that's backing you, and is offering their time over coffee, or at worst case scenario, they're on a deal that's vesting over 3, 4, 5 years for a couple of percentage points in the business, then yes, if they're genuinely adding value, that's okay. What I don't like is people that have suddenly got a panel of 5 or 6 or 7 advisors that actually do nothing to help the company and are just faces on a page, or if they're these types of people that are just finding themselves with 2 or 3% equity in lots of businesses for not, in my view, genuinely adding value. And we will, if that happens. So if we like it, that's great, and we'd love them to be involved. If we don't, we'll ask you to remove them before we get involved. So maybe is the answer to that one.
Great. Okay, and there's one more here. So if there is likely to be a COVID-driven increased demand for the startup, do you see that going away in a short enough time frame to matter? Bit of a hairy one.
So is that like, as in the opportunities going faster or going slower? I didn't quite catch that. What's the question?
Yeah, I guess so, Andy. So it's Andy Dent again. It says, if there is likely to be a COVID-driven increased demand for the startup, do you see that going away in a short enough time frame to matter? So, yeah, I guess if there's an opportunity, if the startups you're looking at are COVID-driven, or they're going to have better opportunities there.
Yeah, look, I think a couple of things quickly on that one. If your core business is going to grow because of COVID, then yeah, growth capital is what we're about, and that makes a whole lot of sense. Probably what I wouldn't support is we were doing this because of COVID. We're going to have a quick pivot to this, and then that's what we're going to build the business on, because I feel like that's gone away from your core and the initial problem. If what you can do is adapting or an immediate fit, then yeah, that's that's kind of pretty interesting. And of course, we would factor that in. I mean, in regards to some of the businesses I'm involved in, I've got at one end a company that lost 50% of forward revenue overnight a month ago when they're laying off staff. And at the other end of the spectrum, there's a company I chair called Curve Tomorrow, and we're in digital health. We happened to launch a product last year, which was around a software product that managed in medical research the relationship between the researcher and the patient who was completing a trial. Turns out one of the hospitals picked that up and said, we could actually use this for tracking COVID cases. And now the World Health Organization's jumped on it, and that company's going gangbusters and we can't keep up. And so that's really interesting. So to me, that was a product that's already in the market that it's not pivoting, it's just being reused for COVID, and that has a faster growth trajectory because of that kind of stuff. Yeah, we'd be pretty interested in having a conversation about, I think.
So there's a question here around, does BetterLabs frown upon startups using offshore resources? Obviously, Derek, you mentioned that you wanted to see WA back.
Yeah, look, I mean, I think I guess coming back to that technology piece, it's more around no issue with how you resource your tech solution up front. You've got to find a way. But ultimately, if technology is your innovation, I do think that's got to be resources that you own and control. Whether that's then an offshore team that is fully dedicated, that's a different kind of conversation. And I think that comes down to an offshoring model. So if it's about someone that's just contracting you through a services business long term, probably not, because there's just misalignment. Probably don't have time to talk about that now. If it's your own offshore team, so that business I was talking about before, I mean, we have 15 developers that are employed by us in India. That's a different kind of proposition, and that would be okay, I think.
Okay. Barry Puller says, stage growth requires time. With the uncertainty in world markets still to play out, 10 times return on a traditional 3-year exit timeframe feels onerous. What is a more realistic post-COVID-19 return on investment timeframe?
Yeah, well, to start with, we're not thinking exit in 3 years. I mean, if you could do that in a normal market, that'd be pretty phenomenal. I don't think many businesses do that. Yeah, look, normally we'd be thinking, we sort of model around a 5 to 7 year trajectory. The company I had, GreenSense, we were 7 years from start to exit. So I know that's doable and what you can get done in that time. No one knows COVID, right? I can't answer the question in terms of realistically how the markets are going to look over the next couple of years. So again, we've got to take that on merit based on the business that we're investing in. 10 times return though, keep in mind, I guess, with that question, if you're thinking that you can maintain the valuation that you had 3 months ago and maintain that, and we want 10 times return, that's probably not realistic, because in the same way the market's not going to move as fast, your business is probably, if it's tied into that, not valued as much. So the valuation price comes down, which means maybe we still can get our 10 times return. And all those things are just through, I'm not trying to be a prick about all that. It's, we actually have a pretty structured model of how we value a business, and that works whether COVID's here or not. And as I said before, touching on it, it really relates to progress and milestones to date. We take a view in time and we attribute value based on where you've got. And then we look at your forward model and do some financial analysis on that. So if that forward model changes because of COVID, then our model actually still translates as to how we value the business.
Brilliant. One last question here. I'm not sure if this, in fact, another one's just popped in. We'll give it probably one more question after this one, which was, does BetterLabs look at addressing IP issues using strategies like affiliate business model?
I'm not sure how an affiliate model is IP related unless it's, I guess you've got some exclusivity on that affiliate linking or something, if that's what you're talking about. I mean, I'd come back to the point I was saying earlier, which is what we are looking for is defensibility. So if it's about, that might be about contracts, whether those contracts are relative to affiliates or something else, and you've got some exclusivity on that, then yeah, that's kind of pretty interesting defensibility. But that's the way I'd try and answer that question.
And I guess this last one is quite interesting. So looking at infrastructure as a service style tech business that relies heavily on open source tech for its package and services, does that affect your opinion of that company and you're likely to invest?
Sorry, can you just read that one again? So they're using open, I just quite
Yeah, so does an infrastructure as a service style tech business fit within the types of business you're interested in? And it's also one that relies heavily on open source tech.
Right. I guess that also depends what you mean when you say infrastructure. I'm not sure whether you're talking about technology or other things, but no, look, I mean, again, at the end of the day, it comes down to part of our due diligence. It's probably the defensibility question again. So if you're saying your defensibility relies around this open source tech, then, no, that's not defensibility strategy, of course. But if it's, if that's just a piece of the puzzle that you need to deliver your infrastructure as a service business, and that's where your defensibility lies, and there's trade secrets there, then the open source thing is probably less of an issue. Whether or not it's a fit for us would depend on whether that fits with our domains and some of the other criteria that we went with. So I can't kind of comment on that, but yeah.
Okay.
Brilliant. Right. Well, that kind of brings the questions to a close. The poll, for those of you who did answer, we had 31 voted. First question was, are you looking for funding? 58% yes, 42% no. What time frame are you looking for funding? 10% said next 3 months, 26% said, 3 months, 26% said next 6 months. 16% said within the next year, and 16% said a year plus, and 32%, the majority, said they are not looking for funding. And in which areas are the areas that they're most looking to, according to the RAC's BetterLabs categories? 6% in clean tech, 6% in third age, life, work, and money was 26%. Mobility of the future was 16%. This was surprising for me, actually. Surprising that there's obviously a market opportunity there somewhere if no one's looking at it, which is next gen insurance. Right. So I don't know if there's a reason why no one's looking at that, but no one answered next gen insurance. Yeah, and then member community was 10%. So it's
interesting. We're finding the next gen insurance, most of the opportunities we're looking there, to be honest, are coming out of the US. I think that market's a bit more developed. And then part of that for us, we're thinking about how do we bring that back to Australia as part of our investment. The one that I'm surprised about, which I think is just hard, but I don't know if it came up on your poll there, is third age. Like, we've looked at a couple. Yeah. I reckon there's got to be, like, we know it's the fastest growing sector, but trying to find someone that's got tech that's landed and doing well has been challenging. So that's definitely something that's missing in our portfolio. So if anyone's in that sphere, we'd love to talk to you.
I shall be in contact.
Fantastic.
Suddenly there's a new one. I got an idea.
Yes. Brilliant. Right. Well, that brings close to close this bit. I'd like to thank Derek and James for taking the time out to run us through this. Obviously, if you do have any further questions for Derek and James, hit up the BetterLabs Ventures website, and if you're looking to apply, everything they can find is on there, isn't it?
Yep, absolutely.
Correct.
Brilliant. Thank you, everybody. When's the next one, Scott?
Again, in 2 weeks' time. Like I mentioned earlier, we've got Jürgen from Niche Interview and Perth Video taking us through no code. So if you are at that validation stage, you really need to test an app and just need to build something real quick. You don't need to go get an offshore team. You don't need to find a CTO. Just build it yourself. No code. So come along and find out how to do it. It should be fun.
Brilliant. Should be fun. Thank you, Derek. Thank you, James. Awesome. Appreciate your time. And for everybody, we will see you again in 2 weeks.
Awesome.
Absolutely.
Thanks, guys. Thanks for having us.
Thank you very much. Bye. Take care.